Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Your food order on Swiggy will now cost 2 rupee more in Bangalore and Hyderabad. Why? Because the food and grocery delivery company has started levying a platform fee on every order, no matter what the cart value is. And it comes days after the company laid off 380 employees and shut down its meat delivery business. So, what is behind the new platform fee? And what does it say about the unit economics of India's online food aggregator platforms? What does this mean for foodies going ahead? Pastor Kumar brings you the answers.
Indians love biryani. It was the most ordered food item on the Zomato app in 2022, with customers ordering 186 biryanis every minute during the year. It was the same for Swiggy, with 137 orders placed every minute. While pizzas and ravioli also found favor with Indian taste buds, given the substantial volumes generated by just biryani, it comes as no surprise that Sher Khan expects India's overall food delivery market to clock a compound annual growth rate of around 12% to reach about $18 billion by FY25 from about $10 billion in FY20. This should leave Zomato and Swiggy, which have formed a settled duopoly in the market, salivating over the prospects of growing their revenues and even becoming profitable. But it appears that at least one of them has realized that this won't be possible without changing its playbook. On April 28th, Swiggy started charging users a platform fee of 2 rupees, regardless of the order size, in a bid to generate additional cash corpus and rein in expenses. Being levied on users from Bengaluru and Hyderabad at present, this fee is likely to be extended to other regions soon. At the moment, it is applicable only on food delivery orders and not on orders on Instamart, Swiggy's quick commerce arm. And while Zomato has not introduced any such fee, Business Standard has reported that it is keeping a close watch on how customers react to Swiggy's move. As of Q4 FY23, Zomato dominates the segment with a 56% market share compared to Swiggy's 44%. And the gap is expected to widen further by the end of FY24. The development also comes after Swiggy saw its losses more than double during FY22, even as its revenue jumped over twofold. Its net loss widened to over 3,600 crore rupees for FY22, owing to a sharp spike in expenditure. Meanwhile, Zomato reported that its net loss widened 50% to over 1,200 crore for FY22, and its revenue from operations more than doubled to almost 4,200 crore, while total expenses also more than doubled. In its Q3 FY23 earnings release, Zomato said that there was a good chance it could reach adjusted EBITDA break-even, excluding quick commerce, in Q4. Meanwhile, a financial daily reported in February that Zomato had approached several restaurant chains seeking a rise of 2 to 6% in commissions. But restaurant operators had refused to accept the hike. This reported move and Swiggy's introduction of a platform fee are an indication of where the unit economics of the online food delivery business stand in India.
These players have been in the market for more than 7 to 8 years. And despite that, they are struggling to get a big profitable margin, right? So I think there are clear concerns. They are trying to increase platform fee. I believe that is a measure. But broadly, if you look at the unit economics on a per order basis, they make close to 110 rupees on a per order basis, which is a mix of delivery charges and the restaurant commission that they get. The major cost herein is the delivery charges, which is about 60 rupees per order, which they pay to the delivery person, and then there are other costs, in terms of customer acquisition, discounting, and the tech of the platform or the user experience rather. So I think it seems to be in a very pressed environment right now, wherein the restaurants are right now refraining to increase take rates Delivery charges obviously can't go up because order values are very small, close to 400 rupees. So they're trying to basically, be innovative over here, trying to, take maximum out of the customer and trying to charge them, from a platform fee perspective.
Indians are also increasingly embracing quick commerce, which involves 10 to 30-minute deliveries. But even as consumers flock to instant delivery platforms, profitability is nowhere near on the horizon. BharatPe co-founder Ashneer Grover said that the 10-minute delivery model was plagued by low ticket size and low margins and had no economics.
Instant commerce is all about a better customer experience. It's about sweating your existing assets that you've already invested in, doing that a little more efficiently. So it serves other purposes. It's not primarily to make money. Instant delivery is going to be a loss leader. One has to very cleverly use it in the portfolio to achieve objectives of customer experience and maybe driving more customers into the proposition.
Coming back to online food delivery, what can foodies like you expect going forward?
If you look at food delivery, there's no return over there, but the per order cost is very high in terms of delivery charges that you pay to the end delivery person. Your order values are very low. So if you look at retail, fashion, these business order values are 1,050 rupees per order. Here, the order value is only 400, 450. So there's very little to be made, by the platform. So I'm saying there are going to be innovative ways in terms of when the customer will be asked to pay in the form of delivery charges, platform fee. It could be lowering of discount. It could be in the form of membership. I think these things will keep on evolving.
The Indian customer will come to terms with some of these incremental charges because what is the alternative? The alternative is that many of these services might shut down, right? If they don't have a profitable business model, right? And hence, I think practically Indian customers do understand it, but they will register their protest every time there's a price increase.
Ultimately, the likes of Swiggy and Zomato may have to look at new means of monetization. And some of those new avenues may involve the consumer shelling out more for their beloved biryani. However, the impact on our wallets won't be too large because both companies know that India remains a price-sensitive market.
In this technology-driven world, a tiny component is running the show. From the phone you use to order food from Swiggy or Zomato, to your smart TV and car, to satellites in the sky, semiconductor chips are everywhere, and most of them are made in the tiny islands of Taiwan. But recently, supply chain disruption forced the nation's semiconductor industry to look for alternatives. They're exploring safe destinations to move their manufacturing facilities. But they haven't turned to India so far. Why is it so? And what should India do to make it an attractive destination for chip manufacturers? Tariq Ahmed speaks to experts for answers. From satellites connecting the world from low Earth orbit to a modest hamlet in a remote Pacific island, the humble semiconductor chip has changed the way we live and work around the world. However, the semiconductor industry relies on a complex supply chain and global trade of raw materials and technologies. Not surprisingly, the recent global supply chain crisis triggered by the pandemic and Ukraine war created a perfect storm for the industry. The chip shortage is not over yet, but the simmering geopolitical tension between the US and China now poses a threat of another disruption, as Taiwan remains the center of global chips manufacturing. Taiwan produces 60% of world's total semiconductor chips and 90% of advanced sub-10 nanometer chips. The world's largest contract chip manufacturing company, Taiwan Semiconductor Manufacturing or TSMC, and the world's biggest outsourced semiconductor assembly and test or OSAT provider, Advanced Semiconductor Engineering Inc., also known as ASE Group, are from Taiwan. Considering the geopolitical tension in the region, chip manufacturers in Taiwan are exploring relocation to the US and other Asian countries to build chip manufacturing facilities or fabs. TSMC has already started building a fab in US, Arizona, and majority of Taiwan's OSAT firms are reportedly moving to Malaysia's Penang Island, but India is yet to attract any major OSAT firms from Taiwan.
You see, for anybody to come and invest in our country, they are looking for a few things to happen. Firstly, ease of setting up or investing in our country, it should be easy. And ease of doing business overall. I think that is a challenge that Taiwanese company always face in India compared to other Southeast Asian countries like Philippines or Thailand or Malaysia. So one challenge they see is that investment climate in terms of the ease of getting approvals, compliances needs to be improved upon. Number one. Number two is that why would anybody want to invest here, particularly in the considering the fact that semiconductors are in zero duty regime. So any semiconductor that is imported into the country, it does not attract any duty. So why would anybody, and semiconductor requires scale. So, they have their OSAT companies in Taiwan or in other countries where they are able to cater to the larger market. And if they come and set it up here, what is the advantage? There is no duty barrier. There is no non-fiscal barrier. So, they say we might as well, produce it at the current locations where we are producing, or we produce it at places from where it is easy to export. So that's why they prefer destinations like Thailand or Malaysia. They don't seem to prefer India as a investment destination for OSAT or ATMP, semiconductor packaging.
For over a decade, India has expressed interest in the semiconductor industry and aspires to be a hub in the region. In 2021, the government announced a design-linked incentive scheme to offer financial assistance and infrastructure support for semiconductor design. US-based chipmaker Micron is also in the final stages of getting clearance to set up an assembly, testing, marking and packaging plant in India, also known as ATMP plant. While absence of Taiwan's OSAT firms was seen as a setback for the country, the recent Foxconn Vedanta JV is now seen as the start of a Delhi-Taipei engagement. Industry observers believe Taiwan's OSAT firms are concerned about India's lack of expertise in the field and ease of doing business. Reliable power supply and abundant water are essential requirements of semiconductor manufacturing, which continues to be the areas of concern. Skilled employees and transport infrastructure are among the other stumbling blocks.
India has to, sell the idea of that India itself is a very big domestic market. And there are certain segments in the electronics space which are fast growing. Whether it is mobile phones, whether it is IT hardware, whether it is electric vehicles, whether it is telecommunication, consumer electronics, etc., which all of them use semiconductors, and therefore semiconductor packaging is necessary. So what India has to do is aggregate the market demand and prove it to these investors that India has a huge demand which is only going to grow.
According to specialist talent solution company Xfino, India currently has more than 1.3 lakh skilled professionals to cater to the needs of this industry. But most of their skills are still at entry levels. There is lack of talent at the expert levels. However, chairperson of the Electronic Industries Association of India is optimistic about the industry's growth in India in the years to come.
Already we have seen the first memory packaging unit break ground in India. The first ATMP project is from Elsina member Sersa Semiconductors, which is operational now in Bhiwadi. The building is ready. The machines have moved in. They've started commercial production and the first commercial invoice has been cut. Okay, so it is no longer theory. It is actually happening on the ground. So we just have to wait for the government to take its appropriate, actions. Give them time. I'm sure the results will come.
While the government is keen on its semiconductor ambitions, it needs to deploy proactive efforts to attract international chip manufacturing, assembly, and packaging firms. This would include providing a stable and lasting policy environment and infrastructure for years to come. Did you know that gold is also used in some semiconductors to provide contact pads? Moving on, all that glitters is not gold, as it could be silver too. The white metal has seen a strong performance this year in line with gold, given the recessionary risk in the West and elevated inflation. So, will the precious metal continue its up run, and should you add it to your portfolio? Harshita Singh brings you the answers.
Amid a volatile performance in equities, investors have been favoring safe haven assets like precious metals in recent months. Gold futures, for instance, notched a record high of 61,490 rupees per 10 grams on MCX last week. However, gold is not the only precious metal dazzling this year. On a year-to-date basis, gold has surged 11.3%, closely followed by silver, which is up 10.6%, while Nifty benchmark is flat. While over the last 1 year, silver has in fact outperformed gold and equities by surging 19.6% versus a 19% and 6% gain in the two assets. The surge in the white metal has been led by rising gold prices, a strong demand for the metal for industrial usage, especially in green manufacturing, and a weak dollar.
Silver prices are driven by the gold prices appreciation in the last 1 year. We have seen a strong rally into the gold and silver prices into the COMEX. Also, the outperformance has been there onto the bullion space because the equities have not been performing quite well. So the silver metal, which is strongly followed by the base metal and the 50% from the bullions, is showing some strong performance because of the demand being picked up into the electrification of the vehicles. Also, solar panels. So solar energy is getting a boom into the market where electrifying the automobiles has been the prime importance globally. Now this is going to pick up the demand into the silver prices globally, and this effect is going to last for another 5 to 10 years.
Going ahead, the rally in the white metal is likely to sustain firm demand and hopes of a rate hike pause by the US Fed, which is making the non-yielding asset more appealing. Analysts suggest investors consider buying silver on every dip, but only from a short-term perspective rather than a longer tenure. Devya Gaglani, research analyst at Commodities at Axis Securities, expects the demand for silver to reach an 8-year high of over 1.21 billion ounces, up 16% from last year. This will be led by a surge in industrial usage, increased demand for silver jewelry, and investment in bars and coins. The outlook for 2023 is optimistic, though prices have already rallied a lot this year and investors should buy the metal in a staggered manner on every correction. Silver is further expected to outperform other asset classes like gold and equities ahead. According to estimates, silver could give returns of 12 to 25% over the next 1 year, as against return expectations of 7 to 12% for gold, 4 to 9% for equities, and up to 7% for FDs.
Now, on the short-term basis, silver prices are looking to be outperforming the other asset classes, including gold and equities and FDs as well, because the inline expectation of silver prices from here on into the MCX, which is currently at around 74,000, looks like very much onto the cards towards the targets of around 80,000 to 85,000 in the next 6 months to 1 year. Now, the outperformance will continue into the COMEX prices as well, where the $25 mark is being held into the COMEX prices, and the prices can easily shoot up towards the levels of around $30 mark. So this will be strongly backed by the gold-silver ratio, which is also been trading onto the lower side and hinting that the silver prices will continue the upwards momentum.
Analysts thus maintain a positive short-term view on the precious metal and note that concerns of a recession risk restricting its rally. Today, equity markets action will remain stock-specific. Street will react to Q4 results of Coal India, while Canara Bank, Mahanagar Gas and UPL will be on radar ahead of their numbers.
Meanwhile, the World Bank has recently unveiled a new methodology and improved safeguards for assessing the business climate in up to 180 countries. The Bretton Woods institution will now be helmed by an Indian origin businessman. Ajay Banga's name was suggested by American President Joe Biden. But ever wondered, what is the World Bank? What does it do? Tushar Verma decodes it for you.
On February 23 this year, US President Joe Biden had said, Ajay is uniquely equipped to lead the World Bank at this critical moment in history. Biden is confident of Ajay Banga's experience in tackling urgent issues like climate change. But as the new president of the World Bank, Banga's biggest challenge is the weakening of support for global multilateral institutions like the World Bank itself. Established in 1944, the World Bank is an international organization that provides financing, advice, and research to developing nations to aid their economic reforms. It is not a standalone entity, but a group of 5 separate institutions. All these institutions perform different functions. The IBRD provides credit to middle-income and low-income countries. The IDA offers interest-free credit to the poorest countries. The International Finance Corporation is focused on the private sector and promotes sustainable development. Although the World Bank started with 44 member countries, today it boasts more than 180 members. The IBRD has the highest number of members at 189, while ICSID is low at 158 members. The World Bank is governed by a board of governors, which is made up of representatives from each of its member countries. Over the years, commitments and disbursements by the World Bank to various countries have increased. In 2018, the World Bank Group committed $74,265 million and disbursed $45,724 million. In 2022, it increased to $104,370 million worth of commitments and $67,041 million disbursements. The World Bank Group has 2 ambitious goals: ending extreme poverty and boosting shared prosperity. It works towards reducing the share of the global population that lives in extreme poverty to 3% and increasing the incomes of the poorest 40% of people in every country. To this end, in 2022, the World Bank Group lent $9 billion to the South Asian region. The lending was through its 2 institutions, IBRD and IDA. Transportation sector received the highest share at 24% of the total lending. This was followed by the health sector with a share of 19%. Over the years, the World Bank Group has played a key role in shaping the global economy and reducing poverty. It has also been criticized for its lending practices and focus on promoting economic growth over social and environmental concerns. How it evolves and achieves its missions, especially with its first ever Indian origin president, will be critical in the making of an equitable world.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The World Bank had also been facing criticism over its actions from time to time. About 2 years ago, it had to cancel the Doing Business rankings after revelations of data irregularities and favoritism towards China. That is all for today. For more news, views and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.